Okay, video number 2. In this video, what I want to do is look at the second and third points of what we talked about in the first video. Look at the costs, the flow of goods versus the costs associated with the flow of the goods. Last video we talked about they're not the same thing. The flow of the goods is the physical flow of the goods. The costs represents the accounting that's associated with the flow of those goods, and they're not the same thing. And we're going to look at it in an example using FIFO and LIFO. FIFO and LIFO, two generally accepted accounting ways, 2 out of 4 methods actually, 2 out of 4 methods for accounting for the costs of the goods that we're selling, the costs of our inventory. So, the cost of our sales actually. So what I'm going to do is make up an example, the same example we have in class. And let's look at FIFO, and let's look at LIFO, and let's look at FIFO here. Let's look at LIFO down here. See how they compare to each other. And in both cases, we're selling sneakers as an illustration. And we start the year with a pair of sneakers that costs us $10. And we add another pair of sneakers that we bought, another pair of sneakers that we bought, another pair of sneakers that we bought, and another pair of sneakers that we bought. We have 1, 2, 3, 4, 5 pairs of sneakers. The second time we bought a pair of sneakers, there's our first. We started the year with one set of sneakers. One pair was $10. So we bought another pair later on in the month. We're going to look at 1 month, let's say. We bought it for $10. Third time we bought some sneakers, the prices went up, and they were $20. It cost us $20 to buy that third pair of sneakers. 2 times what our first 2 pairs cost. We thought $20 was bad. Well, the next purchase we made was $30. And the purchase after that cost $30 as well. So we go, wow, here we are with our 5 pairs of sneakers, and they cost us different amounts of money. Well, let's say during the month we sold 3 pairs at $100 a pair. I'm sorry for the chicken scratch in the handwriting. This could get better with time, hopefully. We sold 3 pairs at $100. That's going to be $300, right? $300 in gross revenue. This is our, let's put another color up here. Let's make this our P&L. That's our profit and loss statement. Maybe we can put some balance sheet stuff over here. Balance sheet stuff here, inventory. So during the year we sold, or during the month, we sold 3 pairs of sneakers. And the question is, well, how much did it cost us? How much did those sneakers cost? Well, FIFO says that the first thing in is the first thing out, which means this one, and this one. Those 3 right there are going to be associated with the costs of those sneakers. 3 pairs of sneakers at $100, $300 is going to cost us $20, $10, $10, 20, 30, 40. So the cost, let me go back to yellow. The cost is going to be $40. 300 minus 40 is 260. 260 is our gross profit. That's the gross profit on those 3 pairs of sneakers. Because FIFO says the first thing in is the first thing out. These goods, the first ones, go to the P&L, and these goods then right here go to the balance sheet. So our inventory on our balance sheet, let's make up inventory on our balance sheet. We have cash, marketable securities. Right here we have inventory. What's the balance in our inventory account? It's going to be 30 plus 30. 60. These were sold. Those are left over. And the leftover goes to the balance sheet, which I'm showing right there. So I can put it next to the P&L. Let's look at the same exact situation under LIFO. What do we have for our inventory? We've got 5 things, right? Same 5. Started the year with 10. We added pair, 2, 3. There's adding. 1, 2, 3, 4, 5 pairs of sneakers. This pair costs what? $10. This pair costs what? $20. This pair costs $30. And this pair costs $30. But now we're going to use a LIFO method of inventory. And a LIFO method of inventory says the last thing in, this one, and this one. The last three in are the first ones out. LIFO, last in, first out. So these three now go to the P&L. And our P&L looks like what? Well, what are our sales? Our sales are 300. But what's our cost of sales? 30, 30, 20, 30, 60, 80. Gives us what? 220 for gross profit. Wait a minute. That number is not the same as 260. What's the difference? The difference is how we accounted for the inventory. Because we used a LIFO method of inventory cost evaluation versus a FIFO method of inventory cost evaluation. Our balance sheet is going to have these last two items, actually the first two, will show up on our balance sheet, which we will put over here, and our inventory, gotta find the yellow pen, our inventory is now going to be what? This good plus this good. This sneaker, that sneaker. Those two sneakers are costing what? $20. Interesting, isn't it? Here we have our gross profit of 260 versus a gross profit of 220. What's the gap between that number and that number? It's $40 difference, right? What's the gap between this number and this number? Wait a minute. $40 difference. Same number. This is what I meant in the last video when I said it's two sides of the same coin. So you can look at this scenario and our gross profit under FIFO, our gross profit is 260. Okay, we have a higher gross profit, but we have a higher gross profit and we have a higher inventory value. Under here we have $220, a lower gross profit, but we have a lower inventory value. So the difference, the $40 difference, appears in both places. It appears on both the balance sheet and the income statement. Now in the next video I'm going to tease this out a little more and go into this a little more detail in terms of advantages and disadvantages of each. But for this, I just wanted us to see physically, I wanted to see how these things flow and how it impacts the P&L, how it impacts the balance sheet. So we'll see you in the next video.